Hey, it's Richard, Matthews Wealth Management. This is the last video that we're going to talk about inflation, and the third type is going to be asset inflation. This is the one that takes the longest to work itself through the economy as far as affecting prices, price increases. So we've talked a little bit about how money is created, and the last one we talked about direct spending through the economy, federal spending, and how long that can affect price hikes. But we're going to go back to the Federal Reserve here and talk about interest rate policy, right? So the Federal Reserve is actually there to protect banks from some laws that have certain requirements, right? So if a bank, takes in $1,000 and then it creates a loan where it loans out to some borrower $10,000, that would mean they had 10% as a requirement of capital, right? So they have to have a certain percentage of what they loan out actually on hand, right? And that's to protect us in a whole banking society, to make sure that we can have faith in our banking system. So what we call that is fractional reserve currency, which is just a fancy way of saying they don't have to have everything that they're loaning to somebody else. They can effectively create some short-term currency that disappears when a loan is repaid. It creates additional inflation nonetheless. But banks themselves, if they are falling behind in the amount of capital they have to keep on hand, they need to come up with that somewhere. So what do? They will first go to another bank and say, hey, can you loan me some funds? We need to cover our capital requirement tonight when we close our business. And if the bank has some excess, let's say like Truist and Wells Fargo, then they can come up with some agreement and some interest rate for an overnight amount to just borrow it and make sure they're not breaking the law. So the last resort, or maybe some cases first resort, it depends on the time and place, but banks will go to the Federal Reserve and borrow this money overnight. Okay, so an overnight lending from the Federal Reserve to the banks is what we call the federal funds rate. So federal funds rate. And so when we talk about the target rate for the Fed is 25 basis points, this is what we're talking about. How much is the Federal Reserve going to charge a bank to cover its minimum capital requirement so that it isn't unlawful, right? And so this is a cost to the bank. Okay, federal funds rate. So if the banks are having to pay, I'm going to use 25 basis points, even though we're technically at zero right now. We're going to say 0.25%, and that would be on a daily basis, right, because it's overnight lending. So they wouldn't be paying that much for an overnight holding, just 360th of it. But anyway, so then those banks will use this factor, right, as far as what their cost of doing business as a bank is for loaning, right, because we're covering the basis of loaning laws or lending laws, I guess. So what do banks do, right? They loan money out to consumers, right, and we can call that a credit card. That makes sense, right? We're all used to having to take money out for an emergency because we don't listen to Dave Ramsey and have our little emergency account. Banks to students, right? So student loans are through Sallie Mae and so forth, other types of, federally backed types of loans for students, but ultimately the banks are getting the interest. So student loans. Homeowners, this is a pretty obvious one, and again, federally backed by Fannie Mae and Freddie Mac. We've got mortgages over here, right? And so all of these rates, by the way, credit card rates, student loan rates, mortgage rates, car rates, payday rates, all of these rates, well, maybe not payday rates, that might be different, but all of these rates are going to be based on this federal funds rate. And so who's making that determination? Well, each bank makes their own determination as to how much profit they can get away with hiking interest on the consumers or the borrowers based on what their cost is going to be on a repayment of overnight. Does that make sense? I hope that makes sense. You can't answer me, but anyway, I think that makes sense. So if we're at 15% on a credit card based on our credit history and balance and so forth, or Student loans have traditionally pretty low interest rates. I think there's some high ones out there. I've had some clients with some high ones that have refinanced to lower ones. Mortgages were at very low rates. We've ticked up a little bit in the last year, but still historically crazy low, almost free mortgages. And then the last thing I've got here is corporations, right? So corporations borrow as well, and they don't necessarily have to come from banks here. In a lot of cases, what they are doing is competing with banks. Sometimes banks will be involved, but ultimately what we end up here is corporate bonds, right? So a corporation, let's say, what's a good one here? GE, for example. GE needs, that's a terrible example, but we'll go with it. GE needs to raise some money, right? And instead of issuing more shares of stock or selling more shares of stock to give people ownership of it, they would rather borrow it, especially if interest rates are incredibly low. Because ultimately, if corporates are issuing bonds, they're competing in the bond market of interest rates. And so all these interest rates get tied back to the U.S. Treasury, 10-year yields on bonds and so forth. When you're looking at bond market, it's very different than stock market, but corporate bonds are going to be also in a low interest rate environment, and it's all predicated on the fact that Federal Reserve has zero interest rates, or 25 basis in our example. So if GE is going to issue a bond here, their bond may only be a 1.7% 5-year bond, right? They may need to borrow this, $100 million just for 5 years, and part of their spinoff or whatever it is that they're looking to do with this money on a short-term basis, they're going to pay it back with some interest. And it might be 1.7%, it might be 2.5%. A lot of the interest rate is going to be based on the creditworthiness of the corporation. So a small company is going to have to pay a higher interest rate than a bigger company. Value versus growth, all of that stuff has to do with the type of credit quality of these corporate bonds. But what we're seeing, definitely unfortunately in this scenario, is we've had such low interest rates that these corporate bonds are being underwritten for however many billions of dollars, and when they get that money, they're turning around and they're buying their own stock, right? So when we hear of stock buybacks, what this is doing is they're borrowing it, let's say at 3%, nice round number, and they're turning around buying their stock. Well, what does that do? That bids up the price of their stock, and it consolidates the ownership of their company so that any future gains will be realized by the holders of the company, or the insiders, or the directors, or the councils and so forth. So buying the stock, because we have historically low interest rate, is inflating the price of stocks. Okay, it's also inflating the price of these debts, right? So if you're buying a mortgage-backed security, or student loans through Sallie Mae and so forth, the prices of these loans in bonds and CDOs and CMOs, all that's fun stuff from 2008 we learned about. We can see that the price of everything is also going up, just based on the fact that interest rates are low. So when we talk about easy monetary policy, typically people equate that to low interest rates, right? And if you're looking on a much bigger scale, the decision of interest rates and investment, you used to have an interest rate versus a growth rate. So you'd set that interest rate at like 4%, and if I can get more than 4%, well, I'll risk it in an ownership of a business. Or I'll go the safe route and get my nice guaranteed 4% through a US bond, right? Well, since we have 0%, everybody's going over to the riskier side, and they're trying to get 20% or 100% rate of return right now. So our risk reward has gotten incredibly skewed, and so decision making has gotten strange. And so these bubbles start to create in the markets through stocks, and this is just one example of corporate buybacks. It's affected by having artificially low rates. So when we see a stock market bubble, and the month of January 2022 has been an eye-opener, or it should have been for a lot of people, the growth, large cap growth, mid cap growth, small cap growth, they all took a huge hit in the month of January. And that inflation of the price of, let's say, GameStop, for example, or Bitcoin even, as people sell and start that bubble bursting, that money is turned into cash, right? So now we actually are starting to realize some of the asset inflation once that money is put into cash. Now, whether that gets spent into the economy or goes back into creating other bubbles or goes into productive investment, on a reasonable rate of return with good business practices, generating, reasonable margins and profits, then that could help the economy. So it's not super likely because there's not a lot that's transparent right now when we do things like keep this really low and print money out of thin air. And this whole series hopefully is waking you up to the fact that this was all created, and whether it's purposeful or ignorance doesn't really matter. It's where we are. We've got a lot of bubbles. We've got a huge supply of cash and dollars that are circulating around, and how this bubble bursts as prices increase and what we can do to actually get our companies profitable and laborers working again. There's a lot that needs to be solved. So I hope I've kind of opened you up to what the big picture is, how the inflation was created, how the inflation rolls into pricing throughout the economy. There is a timeline. There's a total amount that we're looking at as well, whether it's that 13 trillion, 7 trillion, 6 trillion of spending and so forth, or of money supply creation in the last couple of years. There's a lot of additional inflation to come, and what to do about it, how to invest for it, what to do as far as your budget planning, your retirement planning, all of your assumptions as to what cost of a living is going to adjust to, Social Security raises to bank on or not, what we're going to do as far as taxes to offset some of this spending. There's a lot of questions out there, and hopefully this has framed the question a little bit better for you. If you have questions or throw up some comments, if you want to call us, talk to us, whatever, very happy to talk about this. As you can tell, that's why I do these. But yeah, thanks for joining us on our little inflation mini-series, and I hope it was informative.